Let me give you a quick guide to paycheck withholding. So the bottom line here is that I want to share with you a few ways to increase your tax refund you never thought about. So we are going to pay attention to how to fatten your paycheck and get a refund. Okay. So here's an overview I want you to pay attention to. The thing is that when we talk about getting a bigger refund or bigger paycheck, you got to ask yourself, which one do you want to go after? Because when you think about your W-4, that's the form that really allows your employer to withhold taxes on your income. You got to ask yourself, do you really want to go with one or the other? Bigger refund or bigger paycheck? So when you start a job, your employer asks you to complete Form W-4, right? This tells your employer how much federal income tax to withhold from your paycheck. So depending on what amount of income and which credits you'll specify on the W-4, the more or less tax will be withheld. Having less taken out will give you bigger paychecks, but a smaller tax refund or potentially no tax refund and a tax bill at the end of the year. So there are some factors that you need to consider when completing your W-4. So claiming credits such as the child tax credit and the other dependent credit will decrease the amount of your withholding. Adjusting for more withholding if you have additional income, a second job, or investments. This is kind of important. Adjusting for less withholding if you are expecting to claim itemized deductions rather than the standard deduction. And any additional income tax you would like withheld from each paycheck. So specifying more income on your W-4 will mean smaller paychecks since more tax will be withheld. This increases your chances of over withholding, which can lead to a bigger tax refund. So that's why it's called a refund. You are just getting money back that you overpaid to the IRS during the year. So by stating that you will be getting certain credits or deductions will mean bigger paychecks and likely smaller refunds, or perhaps owe some additional tax. Okay, so you can actually use a W-4 withholding calculator on many financial websites to help you estimate where you should enter on your W-4. If you have any questions, let us know in the comment section and we'll let you know exactly where to find those financial calculators. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. It's really important to revisit your filing status, okay? Choosing the filing status that best suits your needs can influence the possibility of a refund, and that's what you want anyway. You want to have a refund, but at the same time, you do not want to take too much. You do not want a lot more to be withheld from your paycheck, right? So your filing status determines your standard deduction, your filing requirements, the credits you are eligible to receive, the amount of tax you pay for, or the refund you receive. So there are 5 statuses to choose from, but the most common are married, filing jointly or separately, single, or head of household. Okay, and it's one of those things where you have to be in a situation where you have to ask yourself, do I go for one or the other? Now, you also have to pay attention to not only the federal level, but also the state level, because there are some state implications. So normally when you fill out Form W-4, this is for federal tax withholding, but there is a strong correlation between your status or your profiles with the IRS and what you have with your state tax authorities, and in some cases you might even have to consider your local tax authorities. If you take New York, for instance, you're paying taxes at the state level, but you're also paying taxes at the city level, but also at the county level. So you have several classifications here. And what we talk about here is that you need to understand, if you want to go for a head of household, you cannot actually file also as married, filing jointly or separately. So there has to be some kind of you cannot be married. That's the bottom line. You cannot be married and actually filing as a head of household, because there is a criterion that says, to qualify as head of household, you need to have at least 50. You need to pay for at least 50% of all the expenses in the household, and two people cannot pay more than 50% for those expenses. Right? This is mathematically impossible. Boss, I want to quickly remind you of today's topic. We are having a quick guide to paycheck withholding, how to fatten your paycheck. It's important to understand that if you want to actually have the proper withholding, you want to claim whenever possible the earned income tax credit. So working families, individuals, people who are self-employed, and others who have moderate to low income may qualify for the earned income tax credits. So the EITC, as it's called, decreases the amount of taxes owed and may qualify you for a tax refund. So to qualify, you are required to have a valid social security number, to be a U.S. citizen, a year-long resident alien, or a non-resident alien married to an American citizen, or a resident alien filing jointly. You need to have income from self-employment, from an employer, or from working on a farm. You need to not be claimed as a dependent or a child of another person, and you must be between the ages of 25 and 65, living in the United States for at least half the year. So to actually receive the EITC, you have to file a tax return even if you owe no taxes. So this is kind of cool. What about claiming the child and dependent care credit? So this is another very interesting sort of credit. So this credit, the child and dependent care credit, is based on a percentage of the amount you paid for the care of a qualifying child or dependent. So for this year, the total expenses you can claim are capped at $3,000 for one eligible individual and $6,000 for two or more. If your employer offers dependent care benefits, you are required to deduct this amount. So any qualifying individual is your child who is under 13 years of age, a dependent who is physically or mentally incapable of self-care and who lives with you for more than half of the year, or your spouse who is incapable of self-care and lives with you for more than half the year. So this is important. And so to claim the credit, other criteria have to be met. You cannot file as a married, filing separately. You can't use a caregiver who is a spouse or a parent a spouse or parent of the child. So your child under 19 years of age or another of your dependents. Each qualifying dependent has to have a social security number, and you have to provide the name, address, and social security number of your caregiver. So those are really important elements. Now let's talk about how to fatten your paycheck and still get a tax refund. This is actually, I'm giving you a few hacks here. So when you file your taxes and get a tax refund, most people celebrate, right? But have you ever taken a second to think about what a refund means? Over the course of the year, you paid more federal income tax than you owed. So in other words, you gave Uncle Sam an interest-free loan. So if you would rather have a bigger paycheck and a smaller refund, you can control this. All you have to do is submit a new Form W-4 to your employer to adjust your federal income tax withholding. Now, most tax filers get refunds, okay? This is really what it is. And this windfall at tax time can be handy. However, it may provide even more value spread throughout the year instead of receiving it all at once. So it's one of those things where you have to really pay attention to a few things. Let's talk about adjusting your withholding, which can really move your refund to your paychecks, and that's what you want anyway. If getting your refund throughout the year instead of at tax time sounds appealing, you can adjust your withholding today. So to do so, you just need to fill out a new W-4. That's it. And just submit it to your employer. Just contact your HR department and they will give you a new form of W-4. And so this form requires you to fill in a few sections depending on your situation. So the more accurately you complete the form, the more precise your withholding should be. So for those with multiple jobs or they have a spouse that works, you will need to complete step 2. Otherwise, you can use step 3, claiming dependents, and step 4, other adjustments, to make changes to your withholding. And these options allow you to reduce the tax withheld through claiming tax credits, for example, or deductions. You can also add other sources of income or extra withholding if you find that if you want more money withheld from your paycheck. So it's one of those things where you have to ask yourself what really works for you. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about a guide to paycheck withholding. So I was talking to you before, and I mentioned the term tax withholding calculators. So you have a series of financial calculators that really have specialized in providing value in terms of paycheck withholding. And the question is, it's one of those things where you got to really use them more and more and more to be able to be comfortable here. And it's one of those, so those tools are really cool when it comes to not only tax time, but also beyond, because they give you a big picture view of your refund situation by asking detailed questions. Okay. So you'll need to provide information like your filing status, your age, your dependents, the number of jobs worked, the income from scratch for each position, tax withheld to date or per paycheck, the tax credit information, deduction information, other income you may have. So this is what it is. And now, one thing for sure, if you are stuck on any question, you can always ask. A third-party tax preparer, or you can actually just reach out to a tax software provider sort of support team, and they'll get back to you. They'll answer all your questions. So the thing here is that if you still want to get a refund, there are a few things you need to do. Okay. So basically, the first thing you want to do here is that if you normally look forward to getting a bigger refund after you file your taxes, there is a fairly simple adjustment you can make. First, you want to use the withholding calculator to fill out Form W-4 so you don't get a refund or any taxes. Again, you can get a withholding calculator on sites such as NerdWallet, Forbes. You have you have bank rate and so on and so forth. And you can use the withholding calculator to fill out Form W-4 so you don't get a refund or any taxes. And next, you want to adjust line 4C called extra withholding, which adds additional withholding to each paycheck you receive. To figure out how much you should add, first think about how much of a refund you would like to see after doing your taxes. So once you know your desired amount, divide that by the number of paychecks you get in a year, and take the results and add that number to what the calculator told you to put on line 4C. Assume your tax situation matches exactly with what you put in the calculator, you should get the refund you want. So you should really take the time to work with the withholding calculator to find the balance between a big refund and a big paycheck. Likely, in order for your paycheck to still be bigger, your desired refund amount will need to be smaller than your usual refund, which assumes nothing else has changed to your tax situation. And if your desired refund is higher than your typical refund, your paycheck will likely shrink due to the extra withholding. It's one of those things where you have to really pay attention to how much you're taking home every pay period, and how much of a bigger tax liability you might have at the end of the year. Keep in mind that in order to see the results you're looking for, this W-4 adjustments will need to be made before the start of the tax year. If you make adjustments in the middle of the year, your results may vary. And so you need to turn in your completed 4W-4 to your employer. Very important. So once you need to submit the form to the correct department at your company as soon as possible. The sooner towards the beginning of the year you turn in the form and get it processed, the more accurate the calculations the calculator provided should be for the year. So the effort will be well worth it when you start seeing bigger paychecks or when you get a bigger refund that you're looking for. So this is really important. The bottom line here is that you want to actually save on penalties, okay? Things don't always go as planned when it comes to filing your tax returns or paying your taxes on time. Even if you have the best intentions, you might face an IRS tax penalty for underestimating your quarterly payments, missing a tax filing deadline, or bouncing a check to the IRS. Mistakes happen, but it helps to know the types of penalties the IRS charges and how they are calculated. So it's also a great idea to see your options if you've been penalized by the IRS. So let's talk about the common tax penalties. So you have there are 4 common tax penalties the IRS charges taxpayers, as well as tips for avoiding them. So you have a failure to file, failure to pay, failure to pay proper estimated tax, and you have a dishonored check. In other words, your check bounced. So failure to file means what? Tax returns are always due around April 15th all the way to April 18th, depending on whether the deadline falls on the weekend or not. So, and if you need more time, you can request an extension, which gives you until October 15th to file your return. If you don't request an extension or miss your extended due date, the IRS charges a failure to file penalty. So this tax penalty is 5% of the unpaid tax for each month or part of a month that your return is late. However, it caps at 25%, that's 5 months of your balance. If your return is more than 60 days late, a minimum penalty applies, and the minimum penalty is either $435 or 100% of the tax owed, whichever amount is less. And so to avoid a failure to file penalty, make sure you file your return by the due date or extended due date, even if you can't pay the balance due. And you have a little more leeway if you are receiving a refund. In this case, the IRS would not charge a failure to file penalty if you file your tax return late. However, you can lose your refund if you don't file your return within 3 years of the original due date. You also have failure to pay. So whether you file your tax return on time or request an extension, the IRS requires you to pay the tax due by the April filing deadline. If you don't pay what you owe by that date, the IRS charges a failure to pay penalty. And the tax penalty is 0.5% of the tax you owe per month or part of a month, but it really also caps at 25% of the tax due. So if you set up an IRS installment agreement, the IRS will reduce your failure to pay penalty by 0.25% of the tax you owe while the installment agreement is in effect. So both the failure to file penalty and the failure to pay penalty are charged for a full month, even if you pay the balance due before the month ends. So when both the penalties apply to the same month, the failure to file penalty is decreased by the amount of the failure to pay penalty, so that the maximum combined failure to file and failure to pay penalty is 5% for any month. So this is important. And so to avoid or at least minimize failure to pay penalties, pay your tax in full by the April tax deadline, even if you request an extension. And if you owe more than you can afford to pay as much as possible by the deadline, then pay the rest as soon as you can. If you cannot pay the rest, then you owe within a few months of the due date, you should look at requesting an installment agreement. So let's talk about the failure to pay proper estimated tax. So the IRS has a pay-as-you-go system, which means what? It means you are supposed to pay taxes throughout the year as you earn or receive income, instead of sending a big lump sum to the IRS at the end of the year. So if you owe more than $1,000 when you calculate your taxes, you could be subject to an underpayment of estimated tax penalty. To avoid this, you should always make payments throughout the year via tax withholding from your paycheck or estimated quarterly payments, or both. The IRS calculates this penalty by figuring out how much you should have paid each quarter and multiplying the difference between what you paid and what you should have paid by the effective interest rate for that period. That means that you can have a penalty for one quarter, but not the others. So to avoid or minimize estimated tax penalties, adjust your tax withholding from your paycheck, or estimate your tax bill and make estimated quarterly payments. And remember that those quarterly estimates are typically due on April 15th, June 15th, September 15th, and January 15th. However, if one or more of those dates fall on a weekend or a legal holiday, the deadline gets pushed back to the next business day. And so the IRS also offers 2 safe harbor methods for determining whether you are subject to a penalty. If you meet one of those safe harbor amounts, the IRS won't charge an estimated tax penalty, even if you owe more than $1,000 at the end of the year. So the requirements are that you pay 90% of the tax you owe for the current tax year. So estimate what you will owe and pay at least 90% of the amount by making timely quarterly estimated tax payments or through paycheck withholding. That's the first safe harbor. The second safe harbor is 100% or 110% of last year's tax bill. So pay 100% of the tax shown on your prior year tax return before applying estimated payments, withholding, or refundable tax credits. If your adjusted gross income is more than $150,000 or $75,000, if you are married and file a separate return from your spouse, the safe harbor is 110% of your prior year tax. So the other the other question here is that if you have dishonored check. So basically, if you write a check to cover your tax bill and you don't have enough money in your bank account to cover it, your bank may dishonor or bounce the check. So the IRS charges a dishonored check penalty of 2% of the check's amount unless it's less than $1,250. In that case, the penalty is $25 or the amount of the check, whichever is lower. So to avoid a dishonored check penalty, make sure you have the funds in your account to cover your payments before mailing the check in the first place. Or you can sign up for overdraft protection with your bank. So this is the possibilities are there. Let's talk about how to get tax penalties removed. So the thing here is that there are two common reasons the IRS might consider penalty abatement. It's called penalty abatement. Okay, and you have a reasonable cause and you have first-time penalty abatement. So reasonable cause means if you don't file on time or pay the tax you owe due to extenuating circumstances, the IRS might agree to waive your penalties. Examples of reasonable cause might include a house fire, natural disaster, illness, or an immediate family member's death. Or during COVID, like a couple of years ago, there was a specific situation and the IRS actually has reasonable cause. You also have first-time penalty abatement. So if you're normally on top of your tax filing responsibilities, but just missed the filing deadline or payment due date, the IRS may do you a one-time favor. So to qualify, you must have filed all of your tax returns, pay your outstanding balance, or set up an installment agreement with the IRS, and have no prior penalties in the past 3 years. Now, how long do you have to claim your tax refund? Well, it really depends upon your situation, but normally there is actually a timeline. So it's one of those things where you have to, if you let us know in the comment section what your situation is, and we'll let you know, because every situation is different. So we'll need to know your state and your situation, and then we'll answer your question. But to actually claim your refund, you will just need to have your W-2, or any 1099 forms that you have, and also anything that you can really prove to the IRS that you are indeed the person to whom the refund was due in the first place. Okay, and it's one of those things where you have up to 3 years to claim your refund. Otherwise, you might actually it's one of those things where the IRS will consider that you are not interested. Under certain conditions, though, the IRS will withhold your refund check. It can be used to pay past due student loans, child support, and federal tax debt you owe. So there are those situations where you have to constantly ask. But if you want to know where your refund is at, you want to call the IRS at 1-800-829-1954 to check the status of a refund. If you previously filed a return as far back as the 2021 tax year. So we're talking about going all the way 3 to 4 years back. Or you can use, there is a tool on the IRS website called Where's My Refund? And that can really help you out also when it comes to knowing exactly where your refund is at. Thank you so much for your attention. I really appreciate it. Today was a comprehensive guide to paycheck withholding. So I gave you all kinds of hacks to really sort of increase your situation. I give you the overview and I give you a few pro tips here and there. Thank you so much. God bless you. I'll see you next time. Until then, remember, stay marvelous.